The tariff slowdown has begun. Bookings of container shipments from China to the U.S. are down nearly 50% compared to a year ago, according to shipment tracker Vizion.
New today, consumer sentiment plummeting to one of the lowest levels on record amid a fierce trade war. Retailers are warning of empty shelves reminiscent of the pandemic.
As of June 10th, more than $9.3 billion worth of U.S. exports are now stuck, after 7 major ports across Asia and Europe canceled U.S.-bound shipments. Container ships are being turned away, air cargo is collapsing, and entire industries are bracing for impact. It's a growing global crisis. What's happening now will soon hit store shelves, prices, and your wallet. It started quietly, but now the numbers are impossible to ignore. As of June 9th and 10th, 7 major ports across Asia and Europe have canceled or rejected U.S.-bound shipments. The list includes the Port of Shanghai, Singapore, Busan, Rotterdam, Antwerp, Hong Kong, and Malaysia's Port Klang. According to Drewry Maritime Research and multiple port authorities, these cancellations are part of a growing retaliation wave. Entire containers of U.S. goods, from electronics to grain to auto parts, are now stuck, rerouted, or refused entry. The Port of Shanghai alone removed over 1,200 U.S.-bound containers from its June schedule. Singapore has delayed clearance on hundreds more. The Korean Ministry of Oceans and Fisheries reported that Busan canceled 4 major U.S. shipments in just 1 week. In Europe, the Port of Rotterdam confirmed regulatory delays targeting U.S. cargo, while Antwerp authorities admitted to adjusting customs procedures. In total, more than $9.3 billion worth of U.S. exports are stalled or rerouted, with over 36% of planned U.S.-bound container volume now cut. Experts say this is not a temporary glitch. Alphaliner's June 2025 report warns that blank sailings will likely increase as more carriers adjust routes. The global shipping lanes are closing fast, and this is just the first domino. China's retaliation is moving fast, and it goes far beyond simple tariffs. In May alone, China replaced 32% of U.S. soybean contracts with cheaper imports from Brazil, according to the U.S. Department of Agriculture. And it's not just soybeans. On May 2nd, China ended a key exemption on small-value air shipments. The result? U.S.-China air cargo capacity dropped by 25% in just days, according to the International Air Transport Association. Electronics, clothing, and machinery that used to fly out overnight are now sitting idle. And behind the scenes, China is using more subtle tactics: licensing delays, surprise inspections, and even cyber disruptions, according to a May report from Mandiant, a top cybersecurity firm. Drewry's World Container Index shows a 27% drop in trans-Pacific shipping rates, but a sharp rise in transatlantic rates as companies scramble to reroute. In the past month, China's ports have quietly deprioritized U.S. goods, giving top priority to European and ASEAN imports. The strategy is clear: squeeze U.S. exports while boosting other trade partners. The impacts are already visible. U.S. farmers, manufacturers, and freight companies are seeing contracts vanish almost overnight. And analysts warn this retaliation is now the shockwave is hitting back home. At U.S. ports, the cancellations and delays are stacking up fast. In the first 10 days of June alone, the Port of Los Angeles canceled 12 major vessel calls, more than double last year's pace, according to the LA Port Authority. Across the country, blank sailings now account for 28% of all trans-Pacific routes, Alphaliner reports. California's grain terminals are especially hard hit, with export volumes down 44% compared to last year, says the California Department of Food and Agriculture. U.S. exporters are watching key markets disappear. West Coast soybean exports to China have collapsed, with Brazil taking 68% of the demand. Poultry exports are down by 35%, according to the USDA. And in the Midwest, heavy machinery orders have fallen by 42%, based on U.S. Chamber of Commerce data. For many businesses, shipments that used to move like clockwork are now stuck or canceled. Grain is piling up in silos. Poultry producers are freezing inventory. Equipment makers are delaying deliveries. What was once a smooth export system is now a gridlocked mess. And with retaliation rising, U.S. ports and exporters are bracing for an even deeper slowdown in the weeks ahead. The impact of this shipping crisis is now spreading across the global supply chain. In Europe, key ports like Rotterdam and Antwerp are delaying U.S.-bound shipments through tighter customs checks, according to PortWatch EU's June report. Many European businesses are now turning to local or intra-EU suppliers to avoid the growing risk of U.S. trade delays. In the skies, the picture is no better. UPS and FedEx just announced an 8% reduction in their international freight staff after seeing demand plunge, based on earnings calls from June 6th through 7th. Air cargo rates to Europe have jumped 23%, while U.S. air freight capacity is down by 21%. On the ground, rail traffic in the U.S. is also slowing. The Association of American Railroads reports a 16% year-over-year drop in intermodal volumes. Trucking volumes in key export corridors are down 12% as fewer containers move through ports. Warehouses are now filling up with goods that cannot leave the country. For logistics firms, this is becoming a nightmare. Fewer shipments mean fewer routes, less revenue, and more idle staff. And as companies across Asia and Europe adjust their supply chains to avoid the U.S., the long-term damage to America's trade position is already taking shape. Now the shipping crisis is reaching everyday consumers. Electronics factories across the U.S. are halting production as key components from Asia fail to arrive, says the National Association of Manufacturers. Some factories are reporting delays of 2 to 4 weeks with no clear timeline for recovery. Some even warn that certain products may face temporary production halts. Auto parts are another major concern. Companies like Ford and GM have already warned of upcoming shortages that could affect both car production and repairs. In stores, the signs are visible. Home goods and appliances are disappearing from shelves. According to the National Retail Federation, inventory levels in key categories are now at record lows, with some items completely sold out, and prices are rising fast. The latest Consumer Price Index shows imported electronics, auto accessories, and home appliances up significantly in May. For small businesses, this uncertainty is painful. Many are forced to use 3-tier pricing models. One price if goods arrive on time, a second if tariffs hit mid-shipment, and a third if shipments are canceled. A recent survey by the NFIB found that 1 in 4 small businesses is already reporting serious inventory disruptions. For American shoppers, the impact is now clear. Fewer choices, higher prices, and growing frustration at the checkout line. This shipping crisis isn't like the ones we've seen before. During the pandemic, supply chains broke down due to lockdowns. In the 2008 financial crisis, demand collapsed. But this time, the damage is man-made, driven by tariffs, retaliation, and mistrust. And unlike past shocks, there's no clear timeline for when this will end. Countries and companies are redrawing trade routes, making long-term shifts away from U.S. suppliers. Alan Murphy, CEO of Sea Intelligence, recently explained, the impact of the trade war has caused many shippers to pause or outright cancel shipments. This in turn reduces demand for capacity on container vessels, to which carriers respond by canceling sailings. This wave of blank sailing shows how carriers are adjusting to a world where U.S. trade lanes are no longer stable. Without a diplomatic breakthrough, these patterns could become permanent. U.S. exporters risk losing access to key markets for years, while American importers face higher costs and fewer options. The global trading system is quietly shifting, one canceled shipment at a time. And for both businesses and consumers, this is not just a temporary setback, it may well be the new normal. The global shipping crisis is no longer a distant headline. It's unfolding now, reshaping trade and everyday prices. Subscribe to stay updated as this story develops, and drop a comment below. Have you already felt the impact where you live?